Hello, Eric.
Hello, Richard. It's nice to see you for another week, as always.
It's great to see you. How you doing?
I'm doing great. I always look forward to this hour. I learn so much every time we speak.
I enjoy it as well. So what's
So
on your mind this week?
I'm just so curious after the, FSC financial crisis forum. What surprised you? What's your big takeaways? What's your interpretation of what, everybody learned last week?
Yes, I thought it was very interesting. It was totally unscripted. We didn't coordinate amongst the 5 speakers. That was it 5 or 6? There were definitely some different approaches and some different ideas on timing, but overall, there was a lot of consistency amongst the speakers, even though it wasn't coordinated. And my big takeaway is that there still is a significant probability of another shoe dropping before we start to kind of pull out of the malaise and the lack of growth that we've been in for a while. But that on the whole, probably in a year or so, there's a lot of consensus that will likely be higher in a year than where we are today. But that puts everybody in a really tough spot, because it's like, well, do you wait for the other shoe to drop and try to get in at a lower price? Or, do you just get in and hold your nose? My personal belief is that we're probably going to see some more crisis into September, maybe even October. That's what the technical analysis suggests to me. Fundamental wise too, of course, there's still the debt ceiling crisis. I don't think that the banks are out of the woods. We saw a lot of banks take a hit last week. I think the momentum is still down for the regional banks.
Yeah.
And it's hard to see the stock market really taking off without the regional banks.
Yeah.
Finally, catching a bid. And I think that we're just at a tenuous place right now.
With the banks, are we in the eye of the storm now, or we're not there yet?
I can show you a simple chart.
Okay. I love your charts.
Let me just see. Hold on a second. Pull this up here. So, why are banks in trouble? Okay. It's very simple. If you're a bank, you take in deposits from your depositors, right? And, you put your money in a checking account, Eric, savings account, and you don't get paid much by the bank, right?
Right.
And you could take your money out whenever you want. So banks are borrowing money from you, right? They're borrowing short-term money from you. And then they're lending that money out to others, to businesses, et cetera, for longer periods of time, and hopefully earning more yield than they have to pay you, the depositor. But you also, depositor, can, take your money out at any time, right? So banks borrow short and lend long. Okay, so they're borrowing short-term money and lending that money out long-term. And when they do that, they expect to get more yield from their long-term investments than they have to pay to their short-term creditors, right? We're the creditors of the bank. So, that model works great in normal times, right? How many years has it been, Eric, that we've left our money in the bank and gotten and accepted no interest for it, right? Just been happy to get our cash back. So that was going on for a while until, 2022 right here. So this is 10-year yields, what US treasuries, 10-year treasuries pay in interest rates, right? minus the 3-month yield, what the 3-month treasury bills pay in yield. So back in 2014, you could earn about 3% more loaning your money to the government for 10 years than you could loaning it to them for 3 years. But today, you actually earn almost 2% more on 3-month T-bills than you do on 10-year notes. So as depositors, right, we can take our money and put it into a money market fund, take it out of the bank and put it in a money market fund or buy T-bills and earn 5% or more. Why would we leave our money in the bank, right? But meanwhile, the banks can't earn 5% on their long-term money. 10-year notes are like 3.5% right now. So they got to pay 5% to their short-term, depositors, and they can only earn 3% loaning their money to the government for 10 years. So that's the situation with banks, okay? And that's not changing. Right now, we have the debt ceiling limit fight, right? So I think 1-month T-bills are now 5.5%, maybe 6%. Short-term money is getting more expensive because of the crisis that we're in. And meanwhile, you have the flight to safety idea of, well, where can I hide? Where's it going to be safe? Let me buy 10-year government bonds. Because if, Congress and the president don't come to agreement, all hell could break loose. So that's the situation we're in, right? I don't see those pressures. These are the fundamental pressures that are haunting the banks right now, right? And I don't see those pressures abating right now. I see them getting worse.
So, I don't know. I'll consider myself an average pedestrian looking at the debt ceiling. I keep watching this repeatedly, this big debate over the debt ceiling. As a pedestrian, I look at it and say, they always seem to figure it out at the last second.
Yeah.
Would you say that's the way the country looks at it? We know what happens.
Well, I think that there's more alarm right now because there's a lot less maneuverability in terms of coming to a compromise. Everybody's holding their breath and expecting that, yes, they will come to some compromise. But basically, the country is so divided right now. The Congress is so divided that there's very little cushion. There's very little room for compromise. And, half a dozen conservative congresspeople can hold hostage this, the congressional vote, right? And then on the executive branch side, you have a lot of inflexibility and intolerance there, and refusal to even talk about the, unprecedented level of debt.
But
so,
as it pertains to an unprecedented level of debt,
yeah,
on a more like granular or simpler level, if I have a credit card and I am spending more money than I can possibly pay back, and all I'm paying back is my interest, just as a person, that's not good. Isn't that what we've been doing with this? The debt ceiling, as long as I'm alive, it just goes, they increase it, because what happens if they don't?
Yeah, it's absolutely what is happening. And it's not comprehensible to me either. And so it's not comprehensible to me that there shouldn't be, a deep, profound conversation about it on both sides of the aisle. So to see this like politicization of it is very alarming, but we live in such a politicized environment and the media is so politicized. That's where the real risk is, that if we can't get the politicization out of the way, but that's almost impossible to do right now because, everybody's electability depends on the politicization, depends on the polarization, right? That's where we've gotten to as a country and as a people and as a government, that you don't get elected, unless you're at one of the extremes, and you badmouth, your opponent. You belittle and badmouth your opponent to the point that how can you compromise, right? So this is the real problem, and that's why, that's the risk, and that's what's kind of terrifying right now. Is can we even have any semblance of an intelligent conversation? And can anybody kind of reflect on their own position and see where they might give some ground for, the greater cause of the future of the country and its role in the world, right?
Well, in theory, that's what we're supposed to do. In reality,
that is what we're supposed to do. That's what politicians are supposed to do.
Yeah.
So
in reality, while everybody's like, this is, I don't know if it's going to be the issue of the week, but it's going to be one of them. Yeah. The way that impacts everything else, we're already not feeling confident about spending money. We see banks are failing. We have this whole debate on all of that. Seems like, a perfect storm of not good stuff.
And then when you look at the cycles, and there's lots of indications from the cycles that the crisis isn't over yet. When I put those two together, it's definitely a time of caution for me.
So when you look as it relates to the cycles, like you've already seen that in the cycles. The cycles show you, more or less reflect what we're talking about, which to me makes it even more concerning.
Yeah.
And what is it? Like, what sort of things do you look at in the cycles that tell you just another bad, if I just had that and that alone, it sounds like it reflects what's going on anyway.
Well, Edward Dewey, the founder of the foundation, called cycles the mysterious forces that trigger events, so I certainly believe that we human beings and our leaders aren't as in control of things as we would like to believe and as they would like to have us believe, right? So cycles make a lot of sense to me. Some people get uncomfortable with them because they kind of suggest a certain lack of agency amongst us, but I'm okay with that, And I think we actually need to get back to a little bit less of a sense of our own agency and a little more humility, So
we elected our own agency.
Yes.
That's not working out too good.
It's terrible. It's terrible. And I'm really not trying to get into a conspiracy there, but did we really elect them? And I'm not saying that the votes weren't counted fairly or anything, but the whole process is just people are so out of touch with it, right? It's so just media driven. It's like a TV show. So
it's like a TV, and now the TV show, the news people, that the drama gets more ratings, the drama gets more clicks, the hyperbole is, networks are literally changing while we watch them, and they're changing not to get us more accurate news or more fair and biased. They're getting us what will get them more advertising dollars. So what do we have? What's the resource that we have left when the media literally is fueling many of the things that we talked about? I mean, we're not helping.
You know the media better than most, Eric. You tell me, how did it get this way?
Well, I unfortunately, what I would say is that as a student of my entire life as a news junkie is it's been heading this way for a very long time.
How long?
As a kid in this business, I've told you the story before about the book Danny Schechter wrote. He was a former producer of 2020. This is 40 years old. This book was written. The more we watch, the less we know. That was 40 years ago. So the direction that it's taken, the internet, put everything on steroids and the social media, but the direction that it's taken was not unpredictable.
Okay. Back to the charts. I'd like to make a connection here.
Great.
Let's see, where'd that chart book go?
I love when we go back to the charts.
All right. So this is, to me, where is it actually? It's here. Okay. To me, this is still the most important chart in the world right now. This is 10-year yields. Okay. What the government pays in interest on its 10-year treasuries. This chart goes back to 1787, the Constitution, the writing of the Constitution. All right. So, and you see here this nice cycle. Okay. So you had a peak back here. You have a peak here. You have a peak here. This cycle is about 85, 86 years long. You said 40 years, 40 years since Danny Schechter wrote his book. What was it called?
The more you watch, the less you know.
The more you watch, the less you know. Well, 40 years ago, we had this peak in interest rates. You probably remember it. Many people tell me they had, mortgages that were 20%. So the government was paying 16% annually for 10 years. You could buy a bond and be guaranteed to earn 16% a year for 10 years, in 1982, 40 years ago. So what we've been experiencing for 40 years is a constant decline in yield, a constant decline in interest rates, all the way down to where they fell to nearly 1% on 10-year T-notes. 1%. Instead of getting 16% a year, you're getting 1% a year. So this whole time, there's 40 years of declining interest rates. What's happening? We're constantly taking on more debt. We're constantly refinancing our debt at lower rates, right? And as this price comes, as the yield comes down, debt gets cheaper and cheaper and cheaper. Oh, let's take on some more. Let's take on some more debt.
Yeah.
And then let's refinance it at lower rates. So here we are, down 2017, 18, right? At 1% almost. And then boom, the bottom of the cycle, we get a clear break of that 40-year downtrend. So now, the cost of debt is going up. So, I think that cheap debt allows for more and more noise in the economy, right? The more we watch, the less we know. The signals get harder and harder to correlate to reality in any way. And what is that? That's noise, right? That's the definition of noise. A signal that you can't correlate to anything. So we live in, I say fight the noise. We live in an era of noise that has been fueled by cheaper and cheaper debt that we can keep taking on more of and refinancing, And so now, here we are at the debt ceiling limit. And yes, it's kind of a ridiculous, comical exercise to have to go through, tragic. But this is serious. We can't keep just increasing the debt when interest rates are more than likely to be going up, for another 20 years, 30 years now. Okay. There's been a sea change in the world, and we can't just keep, plodding along like things haven't changed, or that we're going to get back to, the good old days of 2016 and 17 when, First Republic Bank was putting out jumbo mortgages to rich people at 3%, and they were taking them hand over fist because they knew that was free money. So that's the world that I think we're living in, that the cycles, show us that, support that. I think it is a world where, the more you watch, the less you know. And that's why, this particular debt ceiling limit crisis is riskier than the ones of the past because there's very little signal and people aren't really having a conversation, right? The more they talk, the less we know.
Yeah, but
so that seems to me kind of where we're at. And that's why I don't think we're out of the woods.
But as you know, you had a really great description. I forgot what it was, but you should trademark it. Comedy something.
Comma tragic.
Comma tragic. The comma tragic that we're watching unfold. That's a great word. The comma tragic that we're watching unfold right now, which I think, well, I don't know, I'm kind of assuming is going to end up in increasing the debt ceiling. It is not a good move. However, what's the option? And if we take we're going to increase the debt ceiling path, how will that affect the chart that you just showed? Because it seems to me like it's going to be very problematic.
I mean, I'm pretty sure they will increase the debt ceiling. I hope that in so doing, they agree to have substantive talks on the budget, because we can't keep going on taking on debt at the levels that we are when debt is going to get more expensive and can't be refinanced at cheaper rates. So if we don't do that, and my fear is that we won't do that because it is politically difficult to do that, but we have to do it. And if we don't do it, then there will be a catastrophic crisis where the credibility of, the United States takes a huge hit.
But wasn't that, and this is not political one way or the other, wasn't that sort of in theory what the Tea Party tried to do? Bring literally this exact same issue that we're discussing then to today.
Yep. But the Tea Party was a little early in the cycle, and rates did keep going down. And I think a lot of that was artificial. I don't want to overcomplicate things, but I think you'll like this idea anyways. One more chart to share with you. And I think you'll like this term. I'm calling it artificial wealth. Right? We hear a lot about artificial right now, right? Artificial intelligence. I think we've been living, especially since 2002 or so, in what I call the age of artificial wealth. Okay. And artificial wealth is, this is the decline in interest rates that we talked about going back to 1982, coming all the way down to 1%. The average back to 1787 was close to 5%, right? And then this is showing our net worth divided by our productivity. Okay, so our net worth has been going up even though our productivity hasn't been going up. So our net worth has gotten inflated from our productivity. It hasn't been backed up by productivity gains. So, particularly since 2002, you had kind of net worth to GDP being about 4, but now it's gone to 5 and up to 6. This is the axis over here. Okay, so now we're at 6 times our productivity in terms of our net worth. And that's come from, artificially low yields, going back to Greenspan, Bernanke, Yellen, Powell. And that is changing now, right? So, and it's likely to continue for a long time. So that's where I think we're at. This artificial wealth is more of the feeling of wealth and not the reality of wealth, because it didn't come from productivity. And, artificial wealth can go away like that as fast as it, faster than it took to, be manufactured. So I think we have to kind of adjust our ideas. And we have to start to get back to figuring out how to be more productive.
Amen. On that note, I think we should wind up today. And thank you so much again for your insights this week. Perfectly digestible to me. Now we need them to be perfectly digestible to everybody.
All right. I appreciate the questions, Eric. And hopefully we can help a few other people understand it too.
Nice to see you again, Richard.
As always, thanks.